Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Luke Laretive, welcome back to the Australian Investors Podcast, my friend.
Good afternoon, Professor Rask. How are you?
I'm good, mate. We have a couple of companies that we're going to be talking about today as alternatives to buying CBA. And we've got Ben Richards in the studio. Ben, how are you, mate?
Good, thank you, mate. Good to be back.
Good to be back. You joined us recently for our 5 small cap stocks episode, which was a cracker. We mentioned some really interesting names in there, including a company called Australian Finance Group, which was a mortgage aggregator, a mortgage broking platform, if you will, which we probably should have mentioned in this episode because it also has a big dividend yield and it's very similar to CBA.
Except it's good.
Except it's good. So you can see where this conversation is going to go. Do you guys own, at the time of recording, do you own CBA in the portfolio?
No. And have we ever owned CBA in the Seneca Australian Shares SMA?
Not in my time. Yeah,
no. Not since inception.
Yeah. Okay. So Commonwealth Bank, obviously the biggest bank in Australia by market cap.
Second biggest company by market cap.
Behind BHP. And then...
Everyone says I'm an index hugger.
Yeah. But you don't own CBA. So how could you be?
Exactly right.
Do you own BHP?
A little bit, underweight.
Okay.
Index hugger.
Oh, he's whacked me.
So CBA dominates mortgages for primary residents, but also for investors. Westpac had a big presence in that market for a long time. You guys do own ANZ from memory.
Yeah, we own ANZ and Westpac at the moment.
Yep.
We did own NAB, but we sold it. But, you know, maybe my portfolio is not necessarily, like we're underweight ANZ and Westpac relative to benchmark, and we're underweight banks relative to benchmark. So,
but a large overweight has historically been Macquarie Group, which has kind of been the banking exposure.
Yeah.
So we've been, say, like if we're neutral weight banks, we might be like, let's say that neutral weight banks is 12% of index. Well, we might be 7% Macquarie, and then we might throw in Westpac, NAB, ANZ into the remaining bucket, or we might throw something else that's a bit spicier in there where we think there's more upside. But you know, it's maybe different to how when you're trying to beat a benchmark as your job, rather than just make yourself feel good about your portfolio or whatever people's goals are at home. It's a little bit different maybe to how the average punter runs their portfolio.
Yeah. So CBA has obviously been a leader in technology for a long time. You could probably say if you included Macquarie in that, probably not. Like it's probably neck and neck, but compared to the others, probably winning that
I'd say
race.
Macquarie is better at processing loans than CBA.
Yeah, it's Macquarie.
They're the best mortgage bank
platform,
in the world, in Australia
wealth
at the moment.
platform, like broking, they've done very well.
Yeah, forget about all the fun stuff, but even just the mortgage bank's pretty naughty.
So CBA, it's a household favourite, and fair enough, it's performed exceptionally well over a very long period of time, 30 years.
Share price-wise?
Well, yeah, since the 1990, what was the float? I can't remember.
Yeah, like I agree, the share price has gone up. I would say if you were a private shareholder in that business and it wasn't listed, I'm not so sure you'd be that happy.
Well, over the last 10 years, it hasn't performed as well. But over the 30-year horizon, a lot of people at home will be sitting there with big gains on their books. And
my question is how much of that is PE and how much of that is earnings?
Well, that's fair.
That's a big question.
That's the question.
Well, tell us what you think.
Both of you. Well, Ben, you got the numbers in front of you. Why don't you tell? You're smarter than me.
I do have the numbers in front of me. I don't know if I'm smarter than you, but the PE...
Price earnings ratio.
Actually, no, we'll start with earnings per share. Earnings per share in the last 10 years for CommBank. I want to say, what would you expect it to be?
Yeah. What do you? Okay, well, if I indexed at 100 10 years ago, CBA's earnings, how much? What do you reckon they'd be today?
So index at 100, I would say.
Share price is up. How much is share price up over that?
I would say 142.
142. Benny.
104. Up 4%.
And
4% earnings growth in my business, profitable business. If my business was growing 4% per annum in 10 years, I'd be in bankruptcy three times over.
Are you saying 4% per annum or are you saying 4%?
No,
4% total.
Cumulative growth.
Admittedly, you've got COVID in there. You've had a recovery.
But I'm just saying, like, draw a straight line,
Does that
point to point.
does that also include the divestments of the wealth
Earnings per share.
Yeah.
Per share basis, yeah.
Yeah.
So it's accumulate. It counts for capital changes.
Okay.
Adjusted.
Do you have the price earnings ratio on you there?
I do have the price earnings.
Because I was looking at the income growth of CommBank over the last few years. It's like negligible. It's like low single digits.
Yeah, dividend growth. We're going to talk about that in a minute. And yeah, go on, Benny.
Price earnings, I've got it as 21.
Up from 10 years ago.
Hang on, I've actually just got to pull up that chart.
Refresh that fact set. Refresh it.
Fact set's slow.
That's all right, because I've got another chart from you that shows return on equity, which is what the banks say is like their holy grail.
Yeah, that's why you run a bank, is to generate return on equity.
Yeah, but that has fallen since 2014.
And why would that be, Owen Rask? Why do you think CBA's ROE has fallen? And,
Lots of loans, lots of competition.
The other three banks are about the same.
Lots of loans, lots of competition.
So
net interest margins have been squeezed.
if you are under 40 and listening to this podcast, write in the comments if you actually care who you bank with.
Yeah.
You don't, is the answer, right? Anyone under 40 does not care whether they bank with Westpac, NAB, ANZ, CBA. The brands mean nothing to anybody. They're all just vampires as far as our generation is concerned. So all we want is the cheapest interest rate, an app that works, and to be able to move money around and have a credit card. Like, it's not rocket science. Back in the day, it was like, oh, I go into the CBA branch and I talk to my branch manager and it's excellent and whatever. Like, that's what, and as a result, you overpaid. You overpaid for services. But as competition has come into the marketplace, and it's not competition, more banks or competition, everyone's, they've got different sources of funding. No, they all source money from the same places. They all pay roughly the same cost of capital. They all have the same rough regulatory regime in terms of how much they can charge and where they go. But the difference is the consumer. The consumer has changed. And so as a result, you've seen the ROEs trend towards APRA's target range of 10 to 12%, and they're going to be there till the end of time. So if you're paying more and more for those companies who are generating you less and less on every incremental dollar, I don't understand why.
Ben, you did actually send me the answer to that question you asked me before in advance.
Yep.
I didn't realise this.
If anyone ever pretends like, I don't prepare for these podcasts, it's actually, I'm probably going to say it's Owen. It's not me, it's Owen.
No, but this was buried in about 4 emails I received back to back, so it was one of those threaded emails.
And there is a lot of charts here. Just looking at
There's a lot of charts here. I'm kind of
blue and pink chart storm from
catching
Seneca.
up on today's episode. But okay, so you got up the PE ratio? I can't see that.
Yeah, so it's gone from 15 times in 2014 to 21 times today.
Okay, so you're getting, 50% uplift just in the
Yep.
In the valuation. For a business that is generating, I'm going to thumb suck here, 50% less return on equity.
Ben?
It's gone from
Ben's
13.
our data guy. It's gone from 17,
Yes,
18 to
correct.
13.
Broadly correct. We'll give it to you. 17% to 13.
Yeah.
Not quite, but you get my gist.
Yeah.
Yeah. So, in
So
other
like
words,
if that didn't
but
have,
to be honest, it's probably the best of a bad bunch in terms of the quality of the asset.
and that
Yes.
that, my friend, is the reason why it trades on the PE it does. Does that mean it's justified? I would argue no. But it is the fact that it has been able to deliver 4% earnings growth over that period when the competitors have been able to do less.
Yeah.
So that's why it trades on a premium valuation. Do we think CBA has some sort of domination on talent?
Probably not. So, if anything,
Technology? No.
it's probably better than the other three.
Yeah, but for how long, Owen? For how long? Like
Macquarie is probably, if anything, has got to draw on talent. I think Macquarie has more prestige than anything else.
I would rather work at Macquarie than Commonwealth Bank any day of the week. But the point is that I think even Macquarie to one side, if you said just talking about the big four, sort of traditional four mortgage banks, I would argue that these competitive advantages, the reasons why you pay 21 times earnings for CBA today, are things that can or probably will be eroded.
Yeah.
That's just my opinion.
Yeah.
Just don't think they're sustainable.
Yeah. Okay.
Happy to hear someone else's view as well. Like I'm not the arbiter of truth here, but it does seem to me that that valuation differential. If you want to own a bank, I'd rather own a cheap one.
I think the point that we can make here is there are alternatives, and those alternatives in total return terms are, they may seem foreign to people who've only known banks, but there are genuine alternatives that for the next 10 or 20 years provide much more potential in multiple ways. Like,
I suppose, yes, I agree with you. And I think that for people who are focused on dividends and dividend yield and fully franked dividends, I would argue that buying companies on high dividend yields has been proven to be a bad investment strategy. And if you want to focus on dividends, the metric you need to focus on is sustainable dividend growth. So even if the overall yield is low, the dividend growth shows that a business is sustainably growing.
Okay, now put all of the finance numbers and things to one side. Do you think CBA will be higher? Like, so if we took an index from today's point, do you think in 10 years from now, CBA will have a better total return than, say, NAB?
No.
Ben?
Well, just one last point on the charts. At 21 times PE, I don't see any scenario in which it's trading above that. So I would also probably say no.
You think about it, you got NAB on
15 times.
15 times. Do you think CBA can grow? What's that? 21, like 25% faster than NAB?
Well, probably not. NAB's actually had a bit of a renaissance, to be honest. Probably the wrong example. But yes.
I'm just saying, like, if you think that's your view, then you probably should buy your CBA shares. Otherwise, I'd be switching. Not necessarily into NAB, but I'd be switching.
Okay. Fair enough. You posed a question in the email, Ben. CBA or JP Morgan? JP Morgan is not two of the two companies that we're going to talk about, but you've put it in the question. You put it in your email, so I figured return to sender.
I think it's just even you look at CommBank versus global peers, and it's probably the most expensive bank in the world. One thing we've discussed, Luke and I, and also even to clients, is what would you rather own, CommBank or JP Morgan, or what's a better business? And they'll probably say JP Morgan, but JP Morgan trades at 1.7 times book value, CommBank 2.7. So like two times book is expensive for a bank globally. So that's just the exasperation and shock from the CEO of Seneca Financial Solutions.
I actually can't believe that. That's actually out of control.
Yeah.
For a mortgage bank.
So I think the thing is here is what we may be saying and what the message may be is that you may be able to justify it if it was growing or if there was some sort of catalyst for some re-rating or whatever. But
re-rate to what, Owen?
But what I mean is, this is what I mean.
How much higher can it go?
This is what I mean. There seems to be nothing.
I mean, I don't know. I haven't checked FactSet, and Benny, you might
Maybe the only re-rating could be if somehow it figured out how to remove 20,000 people from its business and still maintain income.
The only reason any sell-side analyst has a buy recommendation on this stock, the only good reason is to generate brokerage from their clients. There is no other reason that anyone could reasonably justify with any academic sort of rigor to put a buy recommendation on this stock. Okay, a hold, maybe on quality, maybe on relatives, but that's about it. So, I think if you went through FactSet, you'd probably find that most brokers do have it on a sell, and the only ones that don't are the ones that are focused on retail clients, mid-tier national firms who are literally just trying to generate growth for themselves.
Yeah. Okay. So now we're going to transition to the other side of the table and try and bring something optimistic across. We have two companies.
I better go get a beer before we do that.
And these two companies are further down the market cap spectrum, so mid caps. And extremely established household names, not to the extent that CBA is, but in some households, who knows? KFC is pretty well known.
My household, it is. I'll give you the hot tip.
Definitely, unless you bank with CBA. Do you bank with CBA?
I bank with KFC as far as I'm concerned.
Okay. So the first company is Collins Foods, ticker symbol CKF, obviously a play on KFC. Luke, what does it do?
Well, yeah, they have KFC stores. And they also have Taco Bell stores. And believe it or not, fried chicken is a growth industry.
Okay.
So it's playing on a few thematics here, and I'm not being like, people think I'm trying to be funny when I'm talking about KFC sometimes, but it is actually an amazing it's having an amazing renaissance in a lot of ways. So there's a big trend towards fast casual dining, and when you are in a cost of living crisis,
cost of living,
yes,
yep.
cost of lives, you actually want to have cheap, quality meals to go and enjoy with the family easily on a Friday night, rather than expensive Uber Eats or if you do have delivery, you get these deals and those kind of things. So it actually just plays perfectly into the sort of the zeitgeist at the moment. Mm-hmm. On top of that, you've had a period where, fried chicken, African American culture, that Southern American food has sort of had a bit of a renaissance too. And I think these sort of trends, coupled with Collins Foods being an excellent business, proven to be able to generate consistent earnings growth through consumer cycles with a geographic rollout that kind of reminds me of what Breville do, where you just roll the same formula out in similar markets and get the same sort of results over and over and over again, in a really capital considered, conservative way, without going ham on the store rollouts. It's just a good business. It's pretty, it often sells off sort of post results. People kind of seem to forget about it or switch into something else. It reports in a out of cycle kind of way. So it'll report in June. And I just wouldn't be surprised if the concern around earnings that's come from some of the what people call peers in the Domino's pizzas and restaurant brands and some of the other ASX listed food companies that we've seen a little bit of weakness in just doesn't flow through in Collins Foods as it hasn't flown through before. And you'll see a big earnings re-rate and it'll be back up at $12 or $13 again.
So this is a business that licenses the KFC brand from
Correct.
Yum Brands in the United States.
Correct.
Yep.
Which when you're doing this franchise model, which I think CKF does a bit of both, but you can really scale rapidly. Domino's Pizza, that's kind of been their model on the way up. And I agree. I think the baby's been thrown out with the bathwater because people see Domino's as kind of run into challenges in Japan and other regions.
But they're Domino's problems. They're not market problems.
Yeah. And the expectations kind of, I think the last two results we've made money out of Collins Foods, exact same thing.
Same shit.
Market gets too bearish, sees Domino's result, uncertain cost of living and inflation, chicken, wages. It's just, there's always something.
And what do Collins Foods do every single time?
Reliable earnings print, beat, stock's been up. So
single digit like-for-like sales growth, rolling out 8 stores, dishes done. The only thing that's been a problem for them has been this Taco Bell rollout.
Yeah.
Which they've slowed. They're doing a bit more considered and they're trying to sort of find a market fit for it. I wouldn't be surprised if it works. Mexican's been a pretty good theme in Australia to run, whether it's the Guzman Gomez, whether it's the Zambrero guy who made $1 squillion. What's the other one? I'm forgetting. There's one other one that's done really well. Mad Mex. Yeah. Do we need another Mexican? Taco Bell's a pretty good brand in America. Hasn't really worked here yet. That being said, went past the store the other day, looked really busy. Who knows? Our thesis isn't really relying on Taco Bell.
You guys been to Taco Bell?
I've been there once to try it out.
Yeah.
Wasn't quite my cup of tea, I will admit.
It's no good. What are you going to say on?
They've got a Taco Bell in the hills where you are?
No. They got one, I think, in Hawthorne. from memory.
Yeah.
Yeah. Okay. So Taco Bell slowing down, but the core franchise business or like the core
business. They own
business.
KFC stores too. Like it's not just franchises.
Yeah.
But
Yeah, bit of both.
I think, it's a really good business, growing, and most importantly, like, you know, we can wax on about the best businesses in the world. If you pay too much for them, there's no returns to be had.
Yeah.
So the best thing about this is you're buying a really good quality business at really good prices, cheap prices, and that's why we like it. Why we just bought more of it, and you know, we don't. I mean, this is I don't know what everyone else is like who comes on here, but when we come on here and talk about stocks, we own them and we're buying more. Like it's because we actually believe in what we're talking about. As I said to you before, we try and do stuff with you that's authentic, that actually speaks to what we believe in. Hopefully it comes across as consistent, but like this is just a no-brainer. I mean, like Ben said, I think it's twice in a row now we've made money on results, Young Collins Food, and we'll be there again on results day.
Interesting. Okay, cool.
All else being equal.
So this is a company that has a sustainable growing dividend. Is that what you called it before?
That's the key.
That's the key. That's the
the
key.
key.
But
That's
it's
the
only
key.
got like a 2 or 3% dividend yield.
3.6%.
Oh, 3.6. No, it's better than I
Because,
remembered.
because the share price has come back, it's 15, 16 times PE, historical average 20. So
Talk dirty.
that yield's looking good.
That's
Yeah.
how you talk dirty to me.
Yeah. Okay. So that's Collins Foods, CKF. There's another business which trades under the ticker symbol ARB, and it goes by the name ARB. Anthony Ronald Brown. That's where its names come from. Trades on a lower dividend yield. Who wants to tell us what it does?
Oh, I've talked for a lot. Ben, go.
I just want to say conceptually, as Luke said, with the retail rollout, once you've got a winning concept, one of the easiest ways to make money is that continued store rollout. You've seen it with Lavisa, you've seen it with a bit of Collins Foods, and ARB is another one where you get a successful brand that kind of dominates the category and then you continue to roll it out. So what ARB does specifically is they, from all the way through the design stage, manufacture and distribution, do 4-wheel drive accessories. So things like bull bars, roof racks, lights. I don't actually
Ben
have that. So I've got no idea.
I'll pretend like I'm a real man here. Ben knows nothing about four-wheel drive. Anyone who drives a four-wheel drive knows what ARB is. So
Yes.
if you don't, and anyone knows anything about four-wheel drive accessories, you buy ARB kit.
Yeah.
That is the Hollywood kit. There is a specialist product built on a reputation for exceptional performance, exceptional reliability, exceptional service, exceptional replaceability, interchangeability, all the things you want when you are in a remote location and your vehicle is your lifeblood.
Yeah. Would you say it's like the Gucci of 4x4 accessories? Or
if you said that to Ross Brown's face, I reckon he'd punch you in the head.
Get that quote out on the AFR.
Don't get that. Look, ARB, I didn't say that for the record. I think you guys are manly and tough, not Gucci, all right? I don't know what you would call it, but I don't think it's a luxury brand in that respect. I think it's more of a niche loyalty brand. So, like you only put ARB kit on your 300 series. And if you don't know what any of that stuff just meant, don't worry about it. ARB is not for you. So I think that those sort of loyal customers, it's like an old school. Like I think of it as like a Hilti Tools. So anyone who's been a tradie will know about Hilti Tools. And if you buy Hilti drills, you buy Hilti everything because it is the best quality tradesman standard tools that you can buy. And ARB is kind of like that for four-wheel drive enthusiasts.
yeah, because there are competitors like TJM and Ironman, but while they have brands, they're not as established as ARB.
Yeah, and, I can buy Saucony runners as well, but I don't. Like it's I can get my suit from Caliber as well. Like, do you know what I mean? Like, I don't. Like, it's yeah.
I don't even know what Caliber is.
Tarakash. Ben's got a pair of white sort of fake leather shoes on here, I think.
It was a matter of time before I came on this podcast and my dress sense was brought into it.
Anyway, Luke,
There's a HR issue at Seneca now.
you've got a tie on today, which is you're definitely dressed to impress, mate.
I am. Only the best for you, mate.
ARB does have probably one of the best that I'm thinking of, one of the best growth plus dividend track records I can think of on the ASX.
Yeah,
especially for the last 15, 20 years.
And why is that? The same reason why CBA isn't working anymore is because their customers aren't loyal and they have to compete on other metrics, i.e. price. ARB's customers are loyal. They do deliver a valuable product that is genuinely valued by their customers and offers great value because of its longevity and quality and all the other good stuff. So it's able to reinvest capital at high rates of return, operate on high margins, retain good staff, and then deploy that great culture they've built from a manufacturing standards, from a in-store service standards, from a maintenance and replacement standards out into other markets. And they're moving into the biggest market in the world now, which is the United States. So, and again, we talked about it with another company on the last podcast episode, but the market in Australia is very skeptical of businesses that are going overseas. And sure enough, ARB, high quality business, we've decided we're not that skeptical of what they're doing in the US. And it's had a few, false starts. But sure enough, the green shoots are starting to come. And they get this OEM thing right with Ford and some of the others in the US. They get this store rollout right, distribute their own stuff. Not using distributors I think is probably going to work better. They can take some of their people over there, leverage the manufacturing base they've built up in Asia properly. And I think maybe, just maybe, it's going to start to really move the dial for them.
Yeah. Okay. 28 times forward PE ratio. Ben, is that high?
It is on the high side. Relative to ARB's trading history, it's about in line with the average. But I think it reflects a couple of things. The investment in R&D, which has driven that earnings per share and dividends per share growth. And on that investment that they're making, the return on invested capital. So I think you, Owen, wrote an article last year ranking companies by their return on invested capital. ARB's was 22% over the last 5 years. And that's just about up there with any company on the ASX. So I think the market's willing to back them to execute the strategy to a certain extent. Where I think the upside is, as Luke said, the growth into the US, as well as the growth in the end user base, which, again, I'm no car expert, but just looking at the data, it looks like it's shifting towards the models of cars that ARB is servicing.
Essentially, there's more SUVs on the road, more four-wheel drives, and more people going off-road with those cars. So that's the data.
And the final point is their OEM stuff that they're doing. So
original equipment manufacturer is what OEM stands for.
Yep. Which has always been a competitive advantage of ARB, working with them.
Yeah, because you can do the aftermarket stuff and you can kind of dominate that to an extent. But if you can get in with the Ford and the Toyotas of the world, which ARB has done, that gives you scope to, use a big company's distribution and balance sheet to, bolt on your own products and sell that way as well. So that's kind of why we think, although it may look expensive on a PE ratio, is why it's, one that could outperform and continue to grow that dividend. And
I haven't looked at this, and this may make me look stupid. Ben, have a quick look at just the raw PE ratio, NTM, over 20 years. I'm going to bet the PE has pretty much just gone up and to the right for 20 years. So this business always looks expensive because it's always better than what the market thinks it's worth. And it has just constantly proven to be a better and higher quality business the longer and longer it's gone on. And I think, is that right?
Yeah, so it's gone from about 15 times, sort of gradually trended up over the last 6 or 7 years to about 20, 25.
Yeah.
And then over the last 5 years, it's averaged 25 times or 26, 27 times.
So it's not that expensive relative to history. And given the fact that all of that's been pretty much done on the predication of we're going to dominate aftermarket in Australia, and then the one shift was they went to Thailand with manufacturing and they got a margin uplift out of that. But they haven't really cracked anything material in overseas markets yet. And we think it's only a matter of time.
Okay. So this is ARB, ticker symbol ARB. We've got Collins Foods, CKF. Two really interesting businesses and also really strong on brand. Obviously, people don't know CKF itself, but obviously the brands that it does control here in Australia, Europe as well. Yep.
European business for Collins Foods is serious money. Serious money.
Yeah. Well, everyone loves chicken. Well, not everyone, but nearly everyone.
Yeah, don't get the vegans upset.
Yeah, it's true. Yeah, I mean, that's a whole ethical thing, I guess, for some people. But yeah, don't invest in it. That's obviously your, I guess, opinion of how this industry works. But two businesses that aren't as high as CBA in terms of dividend yield, but definitely making up for it in terms of the sustainability and the sustainable growing earnings base and dividend yields that fall out of that. So two really interesting businesses. And I think you said this earlier on, you do own them.
We own Collins Foods and ARB in the large cap Seneca Australian Shares large cap SMA.
And they're both kind of in the realm of the small caps as well.
And Collins Foods, just went in the smalls.
Just went in.
So, but ARB is probably just a fraction. It's close. It's close to going in for the smalls. I think
it's close. It's 3 billion market cap.
Can you
find something with a bit of... Yeah.
So can we find something at 30 mil market cap that's going to triple rather than, ARB is not going to triple this year.
Yeah.
So it's a horses for courses situation. I wouldn't think that people who are interested in CBA on a Rask podcast are necessarily chasing triple your money type returns.
No. Two good businesses, good franchises in the sense of the brand and that type of thing. So two businesses, I'm betting you'd be happy to talk about if people booked in with you for a call at Seneca. You can get in touch with Luke and the team by heading to the link that will be available in your show notes. Well, that is available in your show notes, I should say.
Take me up on it. I want to talk to you.
Portfolio reviews, you can get in contact with him. You can ask him questions.
To Ben, you can talk to Ben instead. Just book in with
Luke
me.
Luke will be offended,
I want to talk to Ben in the comment.
That link won't be in the show notes.
But you can get in contact with the guys by following that link and ask you questions about companies. Obviously, the wealth of knowledge. Ben, always a pleasure, mate. Thanks for coming back for round 2 on the show.
Thank you, Owen.
And Luke, it's a pleasure. It is a pleasure.
Somewhat.
It's really reserved.
When you're wearing a suit and tie like you are, mate.
I'm in the finest for you.
Yes.
But I appreciate the opportunity, mate. It's always enjoyable.
Thanks again. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.